What if one of the biggest beliefs in the silver market is actually wrong? What if the numbers that many investors watch every single day, the numbers that are supposed to signal a huge move in silver, are not telling the full story at all? Many people believe that when silver leaves major vaults or when large deliveries happen, the price of silver must immediately explode higher. It sounds logical. It feels convincing. But the reality of how the silver market works is far more complex than that. Welcome to Gold Silver Scope, where we break down the real mechanics behind the gold and silver markets in simple and clear terms. In today's discussion, we are going to explore one of the biggest misunderstandings that many silver investors have about the market, especially when it comes to what happens inside the COMEX system. Many investors closely follow certain numbers. They watch how many ounces of silver are leaving vaults. They track how many contracts are being delivered. They look at the amount of silver that is classified as registered. And when those numbers move, they expect the price of silver to immediately react. But then something strange happens. The numbers move, sometimes dramatically, yet the silver price barely moves at all. This creates confusion. Investors begin to wonder why silver is not behaving the way they expected. Some even believe that something must be manipulated or broken in the system. But very often the real issue is not manipulation. The real issue is misunderstanding how the market actually functions. Most of us who follow silver have the same basic goal. We want to buy silver at lower prices and eventually sell it at higher prices. In other words, we want to convert silver into profit measured in fiat currency. That goal is perfectly reasonable. But to succeed in a volatile market like silver, emotional control becomes extremely important. Silver is one of the most volatile commodities in the financial world. Prices can rise quickly, but they can also fall just as fast. If investors allow their emotions to follow every price move, they often make costly mistakes. When the price rises, excitement pushes them to chase the market. When the price drops, fear pushes them to sell at the worst possible time. This emotional roller coaster usually comes from one simple source: lack of understanding. When investors don't fully understand how a market works, every unexpected movement creates uncertainty, and uncertainty quickly turns into fear. The solution is knowledge. When you understand the structure of a market, you can remain calm even when prices move aggressively. Instead of reacting emotionally, you can analyze what is actually happening. One of the most common misunderstandings in the silver market involves the relationship between three different metrics inside the COMEX system. These three metrics are the number of deliveries, the amount of registered silver in vaults, and the price of silver itself. Many investors assume that these three things are tightly connected. The belief is simple. If deliveries increase, the registered inventory should fall, and the silver price should rise. It seems logical at first glance. But when we analyze how the system truly operates, we discover that these numbers are far more independent than most people realize. For example, sometimes a large amount of silver is delivered through futures contracts, yet the registered silver inventory barely changes. Investors look at this and immediately think something unusual is happening. But in reality, nothing strange may be happening at all. To understand why, we first need to understand what the word delivery actually means in the world of financial markets. Many people imagine delivery the same way we think about shipping a physical product. If you order something online, the item is physically transported from a warehouse to your home. But in the COMEX futures market, delivery does not necessarily mean that silver bars are physically moved from one place to another. In most cases, what actually changes hands is something called a warrant. A warrant is essentially a document that represents ownership of the silver stored in a vault. So when a delivery occurs, the silver itself may not move at all. Instead, the ownership document simply transfers from one party to another. The physical metal stays exactly where it was. This small detail changes the entire interpretation of the data. If the silver itself does not move, then we should not expect deliveries to automatically reduce the registered inventory. The two numbers operate in different parts of the system. Understanding this difference is the first step towards seeing why many assumptions in the silver market can lead investors in the wrong direction. Now that we understand that delivery in the futures market often means the transfer of ownership rather than the movement of physical metal, we can begin to separate several concepts that investors frequently mix together. One of the most important distinctions is the difference between settlement and logistics. These two ideas sound similar, but they represent completely different processes within the silver market. Settlement happens when a futures contract reaches completion. At that point, the ownership of the silver associated with that contract is transferred from the seller to the buyer. As we discussed earlier, this usually involves transferring a warrant that represents the metal stored inside a vault. Logistics, on the other hand, refers to the actual physical movement of silver. This includes deposits into vaults, withdrawals from vaults, and transfers between different storage locations. Because these two processes occur in different layers of the market, they don't always happen at the same time. Someone can take delivery of silver through a futures contract and hold the warrant for months or even years without ever moving the physical metal. This creates a time gap that many investors overlook. A delivery might occur today, but the physical silver might not move until much later. In some cases, it might never move at all if the new owner is satisfied leaving the metal inside the vault. This is why deliveries do not automatically reduce the amount of registered silver. The silver remains exactly where it is unless the owner decides to move it. So if deliveries don't necessarily change the registered inventory, what actually causes the registered silver numbers to move? There are several factors. One of them is withdrawals from vaults. If an owner decides to remove their silver and store it somewhere else, the registered inventory will decline. This could happen for many reasons. The owner might prefer a different vault operator, a different country, or even a different market where prices are higher. Another factor involves exchange-traded funds. Some large silver ETFs use vaults connected to the COMEX system for storage. When investors buy or sell shares in those funds, the amount of silver stored in those vaults can increase or decrease accordingly. A third factor involves something called reclassification. Silver stored in vaults can exist in two main categories, eligible and registered. The difference between these categories is simply whether a warrant is attached to the metal. If silver has a warrant attached to it, it is classified as registered and can be used to settle futures contracts. If the warrant is removed, the silver becomes eligible. It still exists in the vault, but it is no longer available for contract settlement. Because silver can move between these categories without physically leaving the vault, the registered inventory can change even when the metal itself does not move at all. Another important point is that these changes can happen long after a delivery takes place. Someone might accept a warrant today, but decide to reclassify the metal months later. That delay can make the data appear confusing to investors who expect immediate changes. Now, this leads us to another very common assumption in the silver market: the belief that these inventory changes should strongly influence the price of silver. At first glance, the idea seems reasonable. If registered silver decreases, many investors assume that supply is tightening, and therefore the price should rise. However, when we examine how price is actually discovered in the silver market, we find a different story. The price of silver is primarily determined in the futures trading market. This is where large volumes of contracts are bought and sold every day. Traders around the world are constantly adjusting their positions based on expectations about inflation, interest rates, currency strength, industrial demand, and global economic conditions. These trading decisions collectively determine the price of silver long before any physical delivery takes place. In other words, Price discovery happens in the trading layer of the market, not in the inventory layer. Deliveries and warehouse balances occur after the price has already been established. This structure explains why inventory changes often appear disconnected from price movements. The price has already been set by the time those logistical processes occur. Understanding this layered structure helps investors see the silver market with much greater clarity. Instead of expecting every vault movement to trigger a price change, we can focus on the factors that actually drive price discovery in the first place. When we step back and look at the silver market over long periods of time, an interesting pattern appears. Many investors expect a strong relationship between the price of silver and the amount of registered silver stored in major vaults. But historical data tells a different story. Over the past couple of decades, both numbers have moved in many different ways. Sometimes the price of silver rises while registered inventories fall. Other times, both numbers rise together. In certain periods, inventories increase while the price declines, and in other moments, the opposite happens. In other words, the relationship between these two variables constantly changes. At times, they appear positively correlated, meaning they move in the same direction. At other times, they move in opposite directions, showing a negative correlation. But when analysts examine the data over very long periods, the overall correlation between these two metrics is close to zero. That means one variable cannot reliably predict the other. This realization is extremely important for investors. If we rely on metrics that don't truly influence price, we may misinterpret what is happening in the market. We might expect a price surge that never arrives, or we might panic when numbers move in ways that seem alarming but are actually normal. The silver market operates through multiple layers, and each layer performs a different function. The first layer is trading, where price discovery happens through the buying and selling of futures contracts. The second layer is settlement, where ownership of metal is transferred through warrants when contracts reach delivery. The third layer is accounting, where warehouse reports track how much silver is classified as registered or eligible. The fourth layer is logistics, where the physical metal actually moves through deposits, withdrawals, and vault transfers. Confusion often occurs because these layers operate independently. Investors sometimes assume that events happening in one layer must immediately affect another layer. But in reality, they often operate on completely different timelines. When we understand this structure, the silver market becomes much easier to interpret. Instead of reacting emotionally to every vault report or delivery notice, we can recognize which data actually influences price and which data simply reflects logistical adjustments within the system. This knowledge does not mean that vault inventories are irrelevant. They still provide useful information about the broader structure of the silver market. However, they should not be treated as a direct price signal. The real drivers of silver prices usually come from larger forces: global monetary policy, inflation expectations, industrial demand, investor sentiment, and macroeconomic trends. By focusing on these bigger factors, investors can make more rational decisions and avoid being misled by assumptions that sound convincing but lack strong evidence. If you enjoy deep analysis of the gold and silver markets explained in simple terms, make sure you stay connected with Gold Silver Scope. Here we break down complex financial topics so investors can better understand what is really happening behind the headlines. And if you found this discussion helpful, consider supporting the channel by liking the video and subscribing to Gold Silver Scope so you don't miss future insights on gold, silver, and the global precious metals market.